Welcome to the Sustainable Finance Masterclass series of lectures and interviews. This interview is with Louisiana Salge. Louisiana is the head of sustainability at EQ Investors. EQ Investors is a London-based business that manages assets for wide range of different parties, for private investors, for what are known as retail investors, but also for institutions. They run a total of 2 billion, and responsible investment and sustainable investing is a major part of their offering to their clients. Louisiana and I are going to talk about engagement activity and about her work as head of sustainability at EQ. So Louisiana, welcome to our session today. Thank you very much for coming in. So I'm very much looking forward to getting a better understanding of your work and about engagement activity, which is so important, I think, isn't it, really? Because it's that moment where investors have to talk to, or have the opportunity rather, to speak to companies and have a direct impact on their behaviour. But I wanted to start by just asking what brought you into the industry. Was it something you always wanted to do? Presumably not, but...
Well, you're quite right in some ways, and thank you for having me today. I've been with EQ for 7 years, right? So that's quite a long time, and it was my first ever job in the finance industry. Before that, I was working in clean tech, so kind of smaller companies that are trying to create a solution for the climate challenge. And when I was working there, I realized that it was really hard for retail investors to invest in some of these really exciting businesses that are creating these solutions that we really need. And I went back to uni to study a sustainable business at Imperial, and I did actually my master's thesis focusing on EQ's positive impact portfolios as the example, and I didn't think I'd get a job out of it at all. I was really excited to kind of showcase what best practice looks like, and then I joined EQ straight after that. But I think just in general, what motivated me into sustainability goes way back. I mean, I'm German originally and grew up, doing kind of gardening with my mum in our allotment and so on, so kind of nature related upbringing. But also then I moved around a lot because of my parents' job internationally, and I spent a lot of time in North Africa, which is, if you haven't been there, a kind of crazy place where a lot of oil wealth meets very unsustainable environmental practices. And when you're there as a child and you see kind of crazy disparities in income, and also, literally abstracting water that, from rainfall that fell like millions of years ago in an unsustainable way and pumping plastics out into the oceans, you get worried about the state of the world, and that motivated me into the entire environmental space, studying that.
Let's focus in on engagement. It's obviously a hugely interesting and complex topic. So how would you define engagement?
So engagement is about the rights that you get when you are a shareholder. So if you're an investor, you're a shareholder. You own part of a company, or you've provided some funding to the company, and therefore part of, I guess, the company's behavior is somewhat your responsibility, whether they're doing something good or they're doing something bad. And engagement is a right that you hold as a shareholder to engage and talk to the company's management, or indeed the board, which is kind of the oversight capabilities of the companies, in order to change something that you might think they are doing wrong, right. Or to enhance something that you think they are doing completely right. So engagement in general is just chatting to the companies, usually with an end objective in mind. So you're engaging for an outcome. In
many ways, well, almost everyone is a shareholder. They all have a skin in the game. They all have an opportunity to participate, but in general they don't. Why do you think that is? Do you think it's because people feel that they don't really have any power, although there might be shareholders in companies? That's often via a pension scheme. There's all these other sort of intermediary players involved in that, so they're quite distanced from it. But I suppose one of the things that you can achieve is giving people more of a collective voice through collective action. So perhaps you could talk a bit about what that looks like.
Sure, I can do. And I think you're right in that everybody could engage. There's just intermediation that means that you feel a bit distanced from the underlying companies. And mainly, if you're a retail investor, often you'll be investing through funds, which hold many, many companies, and maybe even through a portfolio manager like EQ, which is another step removed. So you're totally right. you could potentially engage, but there's a couple of, I guess, levers that you can't pull that aren't at your disposal. So yes, what I do a lot is to collectively speak on behalf of the clients that we manage money on behalf of, because they've decided to invest with a mandate that is a dual mandate to create financial returns, but also sustainable outcomes on people and planet. And collective engagement is essentially trying to pool loads of different voices of different like-minded investors in order to ask something specific of a company or even an asset manager. And it really helps because if you imagine a company gets a call from every single underlying investor, even on the same topic, let's say climate change, they probably ask slightly different things from them in slightly different words. And having one collective voice is often a lot more effective in driving change because of that.
And sometimes does that involve international organizations? So, for example, the UNPRI do considerable work around convening. Perhaps you could explain a little bit about your role there, or EQ's role in terms of being party to that.
Usually you'd want a party involved that isn't an investor to try to collect all of the investors that might agree on a certain topic, so that it's not led by a certain investor. It's just the legality of things. So the UNPRI is, I guess, a collective organization like that. You're a membership organization where you might join and then you agree on a certain topic that you might engage on. The UNPRI Spring Initiative is an initiative focused on engaging companies that are responsible for deforestation and biodiversity loss, on how they can do the things better. The UNPRI Advance Initiative is one that focuses on human rights protections. So yeah, EQ in this case would, for example, join one of these engagement initiatives, which means that we lend our name and our assets to the interactions that the initiative has with companies. That could be letters, joint letters to the board, requesting some of the weaknesses to be mitigated, or it can be directly calling the companies and the people responsible at these companies for improvements. So, for example, I was on a call with Banco Bradesco, which is a Brazilian bank, last week, trying to engage with them on the way that their lending works in the Amazon, because it can be linked to deforestation, and trying to instill greater responsibilities there.
In your view, I think then collective action is the most effective.
Yes.
It's better for companies because then there's a clear message coming up through from the investor base, and also it means there's more capital coming together. So I think in conflict minerals, just the example that I'm aware of, the sort of asset pool we're talking about would be into the trillions.
Yes.
So you would be collaborating with a much broader group of investors, more capital, and therefore more say and greater influence. But it sounds like more of a process than something that's done over a short period. So perhaps you could speak a little bit about the sort of duration of the process. What sort of steps would an effective engagement go through?
I think this goes to a little bit differentiating, a tick box type exercise of engagement versus something that actually delivers effective change. And effective change, especially if you're asking something dramatic from a company, for example, to commit to a net zero plan and have a real strategy behind that takes some time by the company, but also the investors to coalesce around. So the best example I can give you is the Climate Action 100 Plus initiative, largest global initiative on engagement with the top 100 plus polluters in the world. Okay, greatest initiative. When it started in 2019, we were signatories back then, and we still are. Only 5 companies in the top 100 list had net zero plans covering their main emissions. Now, 80% of those companies do, but it took some time. That's 6 years ago, right? So, and I'm sure this didn't come, overnight. And this was a process that you need to reassure those companies, have an iterative process. Sometimes they present what they might think is good, and we might feed back on that, but it does take time. And that's why I think when I look to differentiate what is good engagement and what isn't, having like an absolute number, just we've engaged with 80 companies, is not really what I'm keen to see. I'm keen to see kind of more of a strategy, consistency, and what I love to see is kind of milestone reporting. How far have you pushed that company? Are you stuck? Are they listening to you? Or are you not? So you're getting into the nuance of like what is efficient. efficient engagement and what isn't.
So there'll be ongoing monitoring, for example. So once an engagement process has started, it's also about tracking and identifying, as you say, milestones as the company moves along that journey.
There's something called escalation, which is something that we look for in asset managers when we're trying to distill whether or not their engagement has teeth, as I call it. We could chat. I could call the board of ExxonMobil every year and have a nice coffee and a cake, and they probably will tell me that they don't want to do what I'd like them to do, and that could be called engagement. It's not just, but not very effective because there's no escalatory approach. What we would like to see, I guess, in the strategy of like what is actually going to make a difference is, okay, I meet a company, they don't do anything about the financially material thing that I've identified they're lacking. That to me says, okay, that's a problem, right? And what can I do next? What is in my toolbox as an investor on top of this conversation? And there's loads of things you can do. You can do public letters. You can do collaborative, as we just discussed, bring other investors alongside you. You can do a public statement. You can vote against directors at the annual general meeting. You can propose a shareholder resolution. So all of these things are something that we would like to see time-bound in a way, attached to investors' engagement plans.
Does divestment have a role to play there? I think that's probably the difficult one, isn't it, really? Is there a point at which you have to accept the company isn't going to improve its processes and therefore investors should divest? Or is it better to stay invested?
Look, I'm going to tell you my view, but people differ on this. I personally think without that stick, I think a lot of engagement lacks, again, teeth. I think the ultimate divestment kind of black flag needs to be raised sometimes, and not just because I feel like that's necessary to drive positive change, but also because if I go through that escalatory approach that I just explained to you, and the company still doesn't see why the topic that I've brought up, human rights protection or climate, is material, that's probably not a business that is future thinking and one that I would like my clients' money to be invested in. So it's of course something that I think is necessary to really be that last resort in terms of pushing those companies and those boards to wake up that this is material to shareholders. But I also think once, if they don't act on something material, it's probably not a good investment case.
Okay.
So
certainly one of the things that's happened in the last 10 years in capital markets is the enormous growth of the huge tech names, and they in particular will tend to have corporate governance structures which certainly don't lend themselves to engagement. I mean, the most obvious example of this would be Facebook, I think, where the founder of Facebook has a golden share of sorts that means he has total control over the direction of the company. And similarly, Alphabet, perhaps the world's largest company in terms of data and a lot of influence that it exerts, has an ownership structure which does not lend itself at all to engagement. Do these things present a challenge for someone working in the field of engagement, or how can they be addressed? Very difficult, I would have thought.
Yeah, I think it depends. So you're right. For example, if we're talking about Facebook Meta, I think you're right. You're totally right. 20% official shares, but they have multiple I guess the voting rights attached to them that result in it results to about 60%. Yeah. So you can't push through any shareholder resolutions. Totally right. Unless Zuckerberg agrees, shareholders can't push through anything with shareholder resolutions. But that's just one way of doing engagement. So you can engage directly with the management as a minority shareholder too. I don't think that that's something that you should negate just because of the ownership structure. But you can't escalate. That toolbox that I was talking about, you don't have all of them available to you. So you're totally right in that if they are unreceptive to engagement, which is this conversation, you're probably more likely to have to resort to kind of a divestment angle earlier than in others where you have more in your toolbox, for sure.
So that's a fascinating response around the huge concentration of power in the hands of a very small group of people that's happening in North America, which is obviously I suppose it's a threat to effective engagement, because as you described, it limits the range of options you have. So is there a role there for regulators in potentially policing that with the SEC in the US or the FCA, the UK or continental European regulators? How does that work? Is there a possibility to apply pressure to regulators to ensure that companies are still accountable?
Yeah, so I mean, the limits of shareholder engagement are known. There's huge amounts that should be done that isn't yet done. So I wouldn't like underplay that, right? We should still leverage a lot of the powers that we have. A lot of people use the shareholder structure as a way out of not even bothering. So I do think you should engage. First of all, you're totally right, though, that we can't do it all on our own, right? Responsible investors and sustainable investors, and even any investors, can't force companies necessarily on that way. Regulators have a massive role to play. The regulatory context of the industry. So, if you are a large polluter, they might regulate that industry to change their ways, for example, through a carbon tax, huge role to play. But the financial regulators also have big roles to play. For example, listing rules, right? If you are a company, you are on a stock exchange, there's a great opportunity in a way for listing rules. So the rules that you need to abide by in order to be on that stock exchange to enhance the sustainability credentials year on year. Perfect example, TCFD reporting. This is a bit of a mouthful, but it's essentially reporting on climate risks. That has become mandatory across large geographies around the world now through listing rules, interestingly, because they hold that responsibility. Right. And I think that's really great. Okay. And also the likes of the SEC in the US, they are responsible for agreeing whether or not a shareholder resolution gets voted on or not. So by letting more shareholder resolutions come to the vote, they enable more, investor pressure, or they could disable investor pressure. So there's many tools at their disposal for sure that regulators can use in order to elevate sustainability issues.
Thinking about policy then, because obviously that's a very important influencer over corporate behavior, are there any specific examples of engagement to bring about changes to public policy that you could cite?
Yeah, I can do a couple. So one maybe focused on the rules of the game, the financial sector, and then one about industry and how do you engage on industry and create, the supporting environment for sustainable businesses to thrive. The first one is about the rules which have just been, released last year, which is the FCA's sustainability disclosure requirements. And they are labels attached to funds now available to the public that set a minimum bar for sustainability criteria if you want to call yourself a sustainable fund. And EQ's been engaging with them since 2021 on this and setting the standards for those labels. And because we've done this for 12 years, thank God they were listening to us and they were really receptive. And actually we managed to help, set some of the examples that are now included in some of the policy proposals, which is really important for us because I was really worried about the state of the sustainable investment space and greenwashing because there was no minimum standard whatsoever. Yeah. So that was really important for me, getting products out there that can't greenwash themselves because there is that minimum bar.
So that's essentially an FCA initiative that brought in very clear rules that define what a sustainability fund or an impact fund is. Indeed. So consumers have a, almost like a kite mark, I suppose, really, that tells them what they're getting. And that's certainly a step forward in terms of simplifying what was an incredibly, I completely hear what you're saying. 10 years ago, there were just a million different terms being used for this fund doing that. And very, very confusing. So that's a great example of active engagement with an institution that brought about a shift in policy. Are there any other examples that you'd like to?
Yeah, there's so many. A lot of our engagement would be on policy initiatives out there that enable or prevent some sustainable businesses that we would like to invest in for our clients to thrive. One of the things that we've done recently is in the UK battery energy space. This is a bit niche, but stick with me. So there are, to scale up renewable energy in the UK and everywhere else, we know that the battery from wind farms or solar is intermittent, so it doesn't always flow. The sun doesn't always shine, the wind doesn't always blow. So what do you need? You need battery storage, right? You need huge batteries, and they do exist, and they are held in some companies that you can invest in. What happened in the UK is that NESO, so the National Energy organization that organizes the grid, essentially, was kind of skipping these battery companies when they were balancing the grid. And that was, I guess, an issue with policy and infrastructure. And we actually co-wrote a letter to NISA with other investment managers around the UK to pushing them to address this skipping that was happening, because it was disabling the energy transition in the UK and also preventing these battery companies from having income and preventing therefore the investment case and therefore more flows into these types of things that you needed. And they actually addressed it.
So that's engagement that is supporting the business activities of portfolio companies.
Yes, indeed.
Okay, that's very interesting. I wouldn't actually have thought that that you could do that sort of thing.
It's not always efficient because, of course, they're elected officials and so on. But in this case, it lifted something that was on their to-do list, I guess, slightly up and prioritized that. I don't know exactly how that all flowed, but it did result in a really good end result for our clients as well, and an outcome. Exactly, yeah.
Great, good. Thinking a bit more about engagement here. So you gave an example earlier where you would own a company that was potentially engaging in activities which you objected to, or rather, your base of investors strongly objected to. So that might be connected to fossil fuels, or it might be connected to another activity which is damaging to the planet. But what about a problem where you maybe have a company which is seeking to greenwash, which is seeking to present a product as having sustainability characteristics, and they perhaps use engagement as the excuse to continue to own fossil fuels? I mean, that would be a problem, wouldn't it? And how should we deal with that?
Yeah, it's interesting because actually for a very long time, strategies that call themselves stewardship strategies or engagement strategies, I was very critical over, because they would be holding all of the nasties around the world and there wasn't sometimes enough evidence of them doing anything about it. So to me, that's even worse, because you're kind of continuing business as usual and you're kind of supporting business as usual with very minimal influence. And what would happen, and the way to maybe differentiate this a little bit, and the way that I would go about it is, okay, you're telling me you're engaging. Is it proactive engagement or is it after the fact? So for example, are you engaging after Rio Tinto has had another human rights violation to call them up and say, should have done that? Or are you engaging proactively to instill them better supply chain practices that will prevent that from happening in the first place? And I think we're moving to a more proactive space, and this is what investors are hopefully expecting in engagement strategies. But back in the day, it was more the latter. You're calling people up after the fact, and there wasn't much, I guess, consequence on the back of it. So you've got to be careful in differentiating what exactly people mean by engagement.
So this is good versus bad engagement, I suppose, is what you're saying.
Tick boxy or
process driven, effective, targeted towards a real world outcome.
I think the interesting thing is about sustainable investment is that no company is perfect. They will never be a perfect company. And of course, you wouldn't want to hold anything that is supporting this kind of violation. And there are some red tapes, like our portfolios will have some red tapes, right? Things in corporate behavior or products and service that we just do not want to touch, or would divest on the back of, I guess. But there are always going to be weaknesses in companies, even if they are on the large majority, how you want to toss it up, depending on doing good stuff. So, I mean, if you are a wind turbine manufacturer, right, you can think, okay, great, they're doing a great job, but how are they paying their workers? How's their supply chain sourced? What's the end of life looking like from those wind turbines? Can you recycle them? There's always something to engage on. And I think this ends, it's a good point. Engagement is relevant across any investment strategy. If you're an impact investor, engagement is important. If you are investing in a traditional index, engagement is also important, because you are using it in order to address systemic risks and financially material risks, and essentially doing something to enhance your the impact on the world and your financial returns in the same way.
Just on indexing then.
Yes.
So obviously one of the massive trends in the investment industry is for more and more capital to move to providers of indices. How does engagement still have a place there?
Great question. So I think engagement, because you are in an index, just for clarity, if you invest in an index, the passive index, you will usually invest in a larger number of holdings, so more lines, more companies to talk to, essentially. You will also invest with lower fees attached to this, which means there's less resource per fund. Together, toss that all up, it means that you will have less, on average, less engagement, resource, people, attached to investing in a passive fund for sure. However, there's many things that asset manager running exactly the same passive funds could do differently on stewardship, depending on who you are. You can still vote very proactively, so you can use all of the shares in a passive fund and an active fund in order to drive social environmental resolution support, for example. You can still go with an asset manager that has a good cross-fund engagement process, so they will engage on behalf of many, many funds rather than fund-specific, and have a very good stewardship program this way. But it's not guaranteed. And I actually don't think, from my experience, being an active or passive manager, especially when it comes to voting and supporting social environmental resolutions, it's not necessarily the decisive difference.
Okay, but there's never any, sorry, to be clear though, with a passive, there's no divestment opportunity, is there? Because it's a
it depends on what passive
index
yes.
that owns a particular portfolio. I suppose you could engage with the index provider, so you could engage over inclusion or exclusion of particular companies.
Which we do as well.
You do that, yeah?
Yeah.
Could you give an example where you've done it?
Yeah, so we run the EQ Future Leaders portfolios, which is I would say probably the most ambitious you can do when it comes to sustainable passive investing. When we first launched these portfolios, they had fossil fuel servicing in them, just because of the index provider doing, that's just the way that they defined the product at the time. We engaged with our client base and tried to understand what was aligned to most of our clients, and also what was the most engageable. Are these businesses actually going to change their business models from, being an oil refiner to, I don't know, something positive? And we kind of concluded that the engagement potential for these businesses was minimal, because it was really hard to change that business model to something that is positive. And most clients did not want their money connected to a refiner if they were going to divest from the extractor of fossil fuels. So we engaged with the index providers and the fund providers from that index, and managed to get that included in the methodology, so we don't hold that anymore.
So they essentially modified the methodology that selects stocks for that particular index. So that's quite a success then.
It was good, yeah.
Very good. So just thinking about the last 3 years, certainly in the time that I've been advising clients on responsible investment, I think this particular period, probably since Russia's invasion of Ukraine, has been a harder time than in previous decade, because we had much higher inflation. We've got higher background interest rates, higher rates on cash, and certainly the politicization of responsible investment and moves in the US against responsible investment have also been a negative, or headwind, as we like to say, in investing. What sort of impact has that had in terms of the conversations you're having with clients?
I think in general, our client base invests in our impact or sustainable products for two reasons: to create that long-term financial return that they need to meet their objectives, but also for that social and positive impact, social environmental positive impact that we can deliver through those portfolios. And most of them have done that for the right reasons, and they're sticking to it, and they understand that for short periods of time, not for the long periods, that wouldn't be acceptable. For short periods of time, our portfolios can perform different from the market index because we invest in a subset of the market index, right? We still really believe as a house, because we only do sustainable investing, that sustainable investing is the best way for you to meet your financial objectives over the long term, because sustainable businesses are more future fit. They provide things that people need. They meet unmet needs, and they're on the right side of regulation and consumer demand. So we don't think that the long-term story has changed at all. Now, the politicization, you're right, is tricky. So ESG, environmental, social, and governance, never was a political thing. It's about, how does a business look at its stakeholders? Does it treat them right? And therefore, is it minimizing risks and capturing opportunities that are financially material? It was never about the political right or the political left. It's the way that businesses are run and do the right thing. It's been captured, kind of hijacked, I would say, specifically in the US. And it has been a headwind because people that maybe have been on the fence beforehand now have decided, and some people have decided against it. But I think we've seen a lot of people be really motivated by this because they're saying, okay, what Trump's doing, or even Elon, I don't stand with that. I'm more for a world that, cares about climate change and each other. And I want my investments to reflect that. And they're more decisive now than ever about wanting sustainable investment, which hopefully we'll see plan out in a good way in the years to come.
A sort of related question would be, have people's attitudes changed towards certain economic activities or businesses, I should say? So, for example, defense or nuclear. Certainly, most people would argue that the Ukraine has a right to defend itself from an aggressor. Europe is now massively increasing its defense spending. That's going to lead to colossal demand for weapons. Is there a point where investors will start to include defense companies within their portfolios? That's traditionally been one of the most common screens, I think, that people ask for. But perhaps going forward, defense will be an inclusion.
It's been a question that has been raised to me quite often in the last couple of years. I think we need to think about, first of all, defense is about 2% of the world index. So it's a very small percentage of the world index. So whether you exclude them or include them, it's not going to dramatically change your financial outcomes. That's first of all, right? It's very talked about at the moment, but it's not a massive restriction to your investable universe. Is it a sustainable investment though, right? The problem is, if I could tell you for sure that every single, tank and missile is used for defense, not offense, then maybe we could argue that it supports a social good. The problem is that where these operations and technologies end up in which hands is impossible to track. And so the risk attached to defense companies remains from a sustainable perspective, linking them to, war crimes and so on potentially. And that's the kind of financial risk that we want to mitigate. Our portfolios have a nuanced approach to this. So we always exclude controversial weapons. We don't want to have anything to do with them. They are legal in most jurisdictions, and they are hugely controversial, as the name suggests. Weapons of mass destruction and so on, cluster munitions, biological weapons. That risk, that sustainability risk, but also that financial risk in case that link is made is huge. Don't want that. When it comes to something that is more indirect military, we have differences depending on the portfolios. So if you are a company that does provide services to the military that isn't weapons related, some of our portfolios might be okay with it and some others don't. And again, this comes to, sustainability. We could talk about this forever, but it's really personal. Sustainable investing is quite personal. And it's about finding the right thing for you and your values and how you might feel that that's best reflected. And so, for example, if you think about a transport vehicle that could carry weapons or could not carry weapons, that's where we might be a little bit more nuanced, and some of our portfolios might include that versus some others won't. And that's exactly just to the point that, sustainability isn't one size fits all. We have different propositions, different portfolios for different client values.
So looking ahead, is there anything kind of innovative in this space that really interests you at the moment? I mean, I'm certainly aware that it's very rare now that you meet with an investor and they haven't downloaded an app, they've got access to a portfolio and they're viewing funds. So certainly investors have more information than they've ever had before. It's almost a deluge of information and don't know what to do with it. Is there a way that they can kind of approach that, or the businesses perhaps helping them get a bit better understanding of that information?
Yeah, so I mean, I'm glad that you think that. I think a few years ago, clients that were in sustainable mandates didn't have a clue what was happening underneath the bonnet, whether or not what they thought they were getting. And I think only really advisors that were ahead of the game did that kind of client communication. I do think, EQ's done 8-9 impact reports or so on. So we've always done this, but regulation for sure has been pushing all funds or portfolios that claim something sustainable to elevate that information to the client so that they understand what's actually happening beneath the bonnet. I'm not sure that's happening in the same way on stewardship. I think it's still really hard to understand what is good stewardship and what's bad stewardship for, a retail client. But a few things that you might want to look at. Share Action Voting Matters report, publicly available report. It ranks asset managers out in the world that you might have in your pension or in your advice portfolio, and whether or not they've supported social environmental resolutions at companies around the world. So a resolution that might ask a company to set a net zero target or to work on their, plastics policy, for example.
Yeah.
Ranks them for those that have supported most of them or supported very little of them. And you might be surprised by that result. And you probably should worry about if you're investing with those asset managers at the bottom of the list, because they're probably not in line with what you'd expect them to be. So that's one thing that is happening, and clients can do in kind of to get a little bit more of a feel for stewardship.
I think retail investors feel very strongly that they want to be represented, they want their voices to be heard. I mean, not all private investors, but there's certainly a significant number who do. So are you seeing examples where they get that opportunity to speak truth to power in a sense and attend AGMs? Do you see that?
Yeah, I mean, there are things that you can do as a retail investor, a few things just to let you know. So there are organizations like Miller out there that are trying to move the voting rights from the fund manager down to the end investor, which is a great thing. It's about pass-through voting, they call it, kind of relaying that right back down to the retail investor and giving you as the retail investors, the end owner of the capital, the choice to support or not support certain resolutions. So that's great. It's a great technology. It's enabled by some of the platforms out there, some of the pension providers, and is growing, I guess, in excitement and people's ability to use it. And the second thing that you can do as a retail investor, and I've done it myself, I actually attended an AGM last week, and I do it on behalf of EQ, on behalf of our clients, but of course you can do it yourself. You just need one single share in a company. You can buy that share if you want, and you can attend the AGM. It's a very democratic space where everyone's welcome that is a shareholder, and you can ask direct questions to the board, who ultimately are the ones responsible for listening to you because they are kind of working on your behalf. And it's a great way to sit alongside professional investors, people from the local communities that are affected by the company's operations, and really kind of raise your hand and ask them hopefully constructive sustainability related questions.
Just thinking really broadly now about what's happening in the world of responsible investment, certainly something I've noticed in Advisor is that private investors, where they're prepared to take significant risk, will invest directly into small companies. So we now have quite a number of investment platforms. So one of the biggest ones would be Abundance Generation, that's been around now for 10 years or so, where they're crowdsourcing capital from private investors for direct investment. So I suppose, though, that's sort of taking out all the intermediaries, isn't it? It's taking out the advisors, taking out the fund managers, and the investor is going direct. So that's a very direct form of engagement, isn't it, really? Being prepared to put your capital up at very high risk in the belief that you're supporting something which is having a really positive social or environmental impact. Probably the other big example of that would be the FX platform.
Yes.
Yeah. Do you engage at all with those types of platforms at EQ? I suspect it's probably there in the business.
We engage with them when it's appropriate for the client, but as you said, it depends on the client's appetite to risk and ability to take that risk. But I think if you think about engagement and the levers that you have, if you are a direct investor in a business, especially in private equity type investments, you are often a more significant investor rather than investing in a share in Apple, right?
Yeah.
So with that more significant share comes potentially more influence.
Thinking about your 2025 action plan, which I know you published that, there's a report which can be downloaded from the website, and that sets out quite clearly the areas of particular focus for the coming year. And in there was there was a piece around public health, about addressing obesity, about the crisis that's going on in developed countries with healthy eating. Perhaps you could talk a bit about the NGO partnerships that you form in order to be more effective in that engagement.
Yeah, I'd love that. So the way that we think about thematic engagement and public health is a great one, is that we find a issue that needs tackling, like public health and obesity crisis. Then we try to find the fund managers that have exposure to companies that might be somewhat engaged there, try to push them on best practice. We then find a partner, in this case, Share Action's Healthy Markets Initiative and the Access to Nutrition Initiative, both of them NGOs, working to really understand who are the big companies out there, the food manufacturers, the food retailers, that have a role to play in lifting nutritional standards and have a role to play on public health. They create great insights, independent insights on these issues, and we use those partnerships then to engage directly with companies on them. So one of my colleagues is going to Unilever's AGM in 2 weeks' time, I think, and trying to lift, with the backing of all of the other investors in this initiative, some of the shortcomings that they still have when it comes to the percentage of sales coming from nutritionally dense products versus unhealthy foods, for example. We've previously done joint letters to Tesco's to try to get them to disclose more on nutritional profiling and set more targets. And there's actually been a very successful engagement initiative alongside Access to Nutrition and Share Action, these partners, to try to push for change in public health and hold people to account.
Wow, that's fascinating. So through that sort of collaborative action, again, you can be more effective. I think that communicates very well too with retail investors. They can see that you're partnering with NGOs who are already active in that particular space to try and amplify their message through to the companies. So that's terrific. So thank you, Louisiana. Thank you so much for coming in and spending a bit of time talking about engagement and your work as head of sustainability at EQ Investors.
Thank you so much for having me.